Welcome back. The Monetary Policy Committee of the Central Bank of Kenya is meeting today to review the outcome of its previous policy decisions and recent economic developments and decide on the direction of the central bank rate. At its last meeting held on June the 25th, the committee decided to reconvene within a month for an early assessment of the impact of the measures which have been put in place and, of course, the evolution of the COVID-19 pandemic. But joining us to discuss expectations ahead of the meeting is the CEO of Call Street Research and Analytics, Mr. George Bodo, who joins us from Kenya. Good afternoon, Mr. Bodo. Thanks for joining us on the program. Well, some analysts predict that the CBK is likely to retain the base lending rate at 7%, as additional rate cuts will not lead to private sector growth, given the reduced economic activities, of course, caused by COVID-19. Do you agree with this?
Yes, I agree with you, and I think the committee is at crossroads, if you ask me. Some of the measures they instituted a couple of, about 2 months ago, are yet to have an effect in the economy. And as you say, that despite some of the easing measures that they announced, the private sector credit hasn't picked up. And this is largely because, as you rightly point, that the economy remains in a frozen state. There's nothing much happening, largely because of the lockdown measures that were announced in March. Some of them have had a significant negative impact on economic activities. So largely, if you look at, for instance, private sector credit growth, it's under around 5%, and that's very, very low. And I don't think that any additional measures would stimulate credit growth. I think the problem is more on the demand side. When you have a demand side problem, it becomes a bit difficult for the committee on the extent to which they can stimulate private sector credit growth.
Now, how would you assess the impact of the measures that have already been put in place by the monetary authorities, given the evolution of the COVID-19 pandemic, especially since the committee last met in June?
I think that the measures, especially on some of the measures, for instance, they actually cut the reserve requirement for commercial banks by almost 50 basis points, and this released some liquidity into the system. However, we haven't seen any corresponding growth in private sector credit. Now, as I said, the problem is largely on the demand side. The private sector credit growth momentum is still very weak. Some of the things that they did also actually have counter effects. Like, for instance, the local currency has become under immense pressure against the US dollar. And this has actually triggered the central bank to actually sterilize some of the liquidity that they released in the system. They've actually been withdrawing some of the liquidity. So it's actually a policy puzzle. On the one hand, they're actually easing liquidity. They're making it easy for commercial banks to access liquidity. But at the same time, they're actually withdrawing liquidity in the money markets. So it's actually a puzzle for them. And also some of the things they've done also on the look at the price, consumer prices, for instance. Consumer prices are largely remained very stable. Actually, the threat now is that we could have consumer prices decelerating, which is essentially pointing to a deflationary environment because, again, demand side weaknesses. And that can actually become even more puzzling for the committee, and it could be difficult for the committee to fight prices going downwards.
Now, on a broader perspective now beyond Kenya, how do you see most African countries navigating these tough times, particularly caused by the outbreak of a coronavirus?
I think the key thing here is the fiscal side, which, by the way, I need to mention that the fiscal side remains a threat to the efficacy of monetary policy measures being outlined. Essentially, when you have demand and supply side frozen the way it is right now, you really need the fiscal side to be very accommodative in the sense that tax measures need to be very soft. The government needs to roll out, basically the government needs to underwrite the economy. Accommodative tax policies, the spending policies need to be able to gear towards resuscitating businesses and also giving more incentives for businesses to continue employing, which they are not doing right now. For instance, Kenya unveiled an economic stimulus program of just about $500 million, which is not really sufficient to stimulate an economy of $90 billion. And some of the spending priorities that were outlined in that stimulus program, they're not enough to stimulate the economy. And actually, that's the key thing. Even for the other East African countries, the key now is on the spending side. The government needs to underwrite the economy by spending in key areas that will generate jobs and also be soft on the tax side, make sure businesses can be nurtured through this crisis.
Would like to thank you, CEO, Call Street Research and Analytics, Mr. George Bodu. Thanks for speaking with us on the program.